Thank you for joining the Become a Billionaire with Me podcast. We'll journey together through the process of finding, evaluating, and purchasing our first multifamily apartment. On this show, we'll also bring in industry experts to share valuable tips that will help us become billionaires together. Here's your host, Multifamily Martin.
Hey everybody, thank you for listening to the Become a Billionaire with Me podcast today. Today we have a guest who specializes in commercial financing by the name of Roddrick Jones. Roddrick, would you mind telling us a little bit about yourself?
Yeah, thank you for the introduction. My name is Roddrick Jones, and basically I'm a commercial real estate financier. And what that means is there's an opportunity to help a lot of multifamily investors fund their deals. And capital is a big need for multifamily investors.
Yep.
And so that's what I do. I come in and I fund it, whether that's with debt or preferred equity. We can get creative and put together a mix of capital that works best for the sponsor.
Yeah, that's awesome. Maybe stepping back a little bit, what got you into this field? I mean, commercial financing, that's pretty niche. You know, most people when they get into real estate, they'll get into, single family, maybe become a real estate agent, maybe work on some loan processing stuff. What got you into the field that you're in now?
Yeah, that's a great question. So basically, when I first got started, I read the book Rich Dad, Poor Dad. That book sparked some ideas.
Yep.
And I immediately started to wholesale. So I started wholesaling houses first. And then after that wholesaling thing, I felt like wholesaling was a lot of work, and it was just like, it got to be something bigger than just wholesaling,
Yeah.
And so then I transitioned into buying multifamily properties. And then while I'm looking for multifamily properties, I got a lot of capital just sitting. And so it's just like, well, if it's not going to work in my deal, I can put it to work for other people's deals, and I can finance other people's deals. And so that's kind of how the whole thing came about. And then, so the fundamentals are the same. If you're looking at a multifamily property, it's the same fundamentals, except for you're not looking at buying it, you're looking to fund it and give the money out, invest in other people's deals, and become, the bank, if that makes sense.
Yeah, that's cool. What area do you specialize in? Is there a market that you're investing? Is it your hometown? Is it other areas throughout the country?
Yeah, so the main area that I specialize in for me buying personally will be Atlanta. That's my hometown. Nice. But for lending, I can lend nationwide.
Okay, cool, awesome. What do you look for? If somebody has a multifamily apartment that they need financing on, what do you look for in the deal?
Yeah, so typically in any given deal, you can analyze a deal with 5 data points, and the main thing is, where's the property located? What's the current NOI? What's the pro forma NOI? What's the sources and uses? And what's the exit strategy? So those 5 things is what I look at. So, and then we can break it down and tell you, I can break it down and tell you why I look at those 5 things.
Yeah.
So the first thing is the location. So once I get the address, I can tell where it's located. I can tell what's the average median income and everything like that. And then from there, we say, how much is this deal currently performing at? That's the current NOI. How much is this deal bringing in today? If you didn't put another dollar in, how much is it bringing in? And then from there, we go to pro forma NOI, which is your projected. How much are you projecting this deal to bring in? And so with that pro forma NOI and that current NOI, that's where we kind of compare and say, okay, the deal is here, and they're saying they're going to get it here. If that number makes sense, then we can go ahead and do it. But if it doesn't make sense, let's say this deal has 100,000 NOI for current NOI, right? And the pro forma NOI is 200,000, right? But the most this deal can bring in is 150,000. So how does that work? If the pro forma NOI doesn't make sense, then that's the first red flag of, no, this is not going to work.
Yep.
And then from there, we go into sources and uses. How much money is coming in? Like, how much are you going to inject into the deal? How much debt is going to be on the deal? And then from there, what do you plan to do with that money? So do you plan to put it into the deal, renovate the units, do some value adds, add a dog park, fix the leasing center. Like, what do you plan to do with that? And if that story adds up to the pro forma NOI and explains how you're going to get it there, then from there we look at the exit strategy. How many years is it going to take to get this done? And what's your plan on giving us our money back?
Yeah. Wow, that's pretty cool. Yeah, I've never thought of a few value adds like the dog park. I've heard of like daycare centers, dog park. That's interesting. I guess yeah, people do it for dogs, right?
Yeah, but the main value add component that's going to generate the most revenue is the internal, the renovating the units.
Yeah.
So the dog park should be the secondary thing that you do. But this where you're going to get your bread and butter is to renovate those units, increase the rents, and get the NOI up. The dog park, you can sell it as an amenity, but it doesn't have strong value going into it first to do some great things to the NOI.
Yeah, that's true. That's true. And what type of loans do you offer? Do you offer like, FHA, HUD loans? Anything you can shed on that?
Yeah, so mainly we focus on commercial. Mm-hmm. So the loans that we'll offer is Freddie and Fannie. That's like that's the most competitive rates out there. Mm-hmm. And then if Freddie and Fannie doesn't really work for the project, then we can do a bridge loan. And then if a bridge loan doesn't work, then we can do a private loan, or we can do a commercial backed security as well. And basically we can just get creative in what the sponsor really needs. So, it depends on the deal and it depends on the sponsor. Some loans may have a better rate, but it doesn't work for this particular deal. Some loans may have a higher rate and it works better for this particular deal. So it just depends on the deal. And then from there, we kind of structure it the way we need to structure it to say, hey, this one will work better for you, and go from there.
Yeah. What type of down payment do you typically look for when financing apartment complex or mobile home park or something like that?
Yeah, so the down payment is normally 25%.
Mm-hmm.
So we require 25% down, and then we go from there.
Yeah. And what are your thoughts as a lender, people who try to raise 100% or get 100% financing? I host a meetup group here in the San Francisco Bay Area, and I had a guy talk yesterday. This guy is taking down a 15-unit retirement facility for $15 million, and he's pretty much raising all of the money, from private lenders, for his down payment, and then financing the rest. What are your thoughts on people who try to, finance a commercial property 100% without down payment?
Yeah, so my thoughts is it's definitely possible, but it's harder. Yeah. And from a lender's perspective, we're at 75%. So once we underwrite the deal, you have 75% of the capital. It's up to the sponsor to come up with that other 25%. Yeah. And once you come up with that 25%, you can go out and raise it from other people as long as it hits the 25% metric that is required to put down a down payment. So even if the sponsor goes out and raises the other 25%, we see this 25%, and on his end, he used 100% financing for this deal. But he got 75% from the bank, and then he had to go out and raise the 25% equity, which is required to get the deal done.
Yeah. Do you, as a lender, feel that it's more risky when someone tries to do that because they don't necessarily have any skin in the game? What are your thoughts on that?
Yeah. And so that's the reason why we require a down payment, because if you have money in the deal, then you can't just easily walk away from the deal. Yeah. And so from a lender's perspective, if it just depends on the sponsor. So the sponsor and the group, that's what we look at. So if the sponsor goes out and partners with other people who've done deals like this before, and he just puts together a good sponsorship team, and they come together collectively with the money, that's the area where we really look at to see who's running this deal. And that's how we minimize our risk. Because if the sponsors have done it before and they do these deals all the time and it's just another drop in the bucket for them, then that's not really, it minimizes our risk. And so most people like to say, if you have money in a deal, if you don't have money in a deal, you like to see skin in the game, but it's subjective on a per deal basis. But most lenders, from our perspective, we like to see some skin in the game, and that's why we require 25% down. And whether that comes from you or a group of individuals, as long as the 25% is there.
Yeah, that's awesome. Cool. And what type of properties do you lend on? Do you lend on all residential, all commercial? You know, whether it's multifamily, retail, mobile home parks. What's your specialty? Can you guys do everything, or what do you like to finance?
Yeah, so mostly our specialty is just commercial. So we only focus on commercial. We don't really do residential,
Mhm.
but commercial, and we can invest across all four groups. We can lend on all four groups, our four food groups. And those food groups are, office, retail, industrial, warehouse, multifamily. We can lend across all of those,
Yeah.
and we can do it nationwide. But we really specialize in multifamily, but we can lend across all four food groups of commercial real estate.
Yeah. What are you seeing the best returns on, right now in this market? I hear, multifamily space is getting really tight. It's hard to find a deal. Last night, at my meetup, this guy shared some numbers on, this crazy, return that he's seeing in his old folks care facility. What investment niches do you think are a safe bet, in 2020 and going forward?
That is a great question. And I would answer that question with, it depends on what the investor is looking for, because every investor has a different criteria. And for multifamily, the returns are still in multifamily, but you have to look at a lot more deals just to find what you're looking for. Before in the past, you didn't have to look at 200 deals to find a good deal. You didn't have to look at 300 deals to find a good deal. Now that's the case. And so it's going to be the case until, the correction comes or it balances out. And so I still think the returns are in multifamily. Another industry to look into is, I would say, it just depends. It depends on the investor. So it just depends. But we really focus on multifamily, and multifamily is the bread and butter, and I believe in it 100%. And it's just, maybe you have to look at more deals before you find a good one. But the good ones are out there. But the only thing that I say, or that I advise, is to be a disciplined investor. Most investors just want to do a deal so bad just to say they did a deal. But however, if you do this deal, you have to deal with it once you close on it. So if it's a bad deal, you have to ride that wave out for 5 years. Or if it's a bad deal, you have to ride the wave out until the bank forecloses on it, or until the lender comes back and say, hey, you're not doing what you're supposed to do. We're foreclosing. Give us the property back. So that's the things investor has to think about. You want to do a deal, but is this the right deal to do? Does it generate the returns that you're looking for? Is it a 1.25 debt service coverage ratio? Does it hit the preferred returns to your investors? If the answer is no to any of those questions, if it doesn't fit your investment metric or your investment philosophy, then don't do the deal. Just to say you did a deal, why would you do a deal to say you did a deal? You should do a deal to say it was a good deal. You returned your investors' money, and it was a valuable decision for everybody.
Yeah, that's definitely a good thing to consider. We talked a little bit about some numbers, a little bit on what you look at. What as someone who's looking to purchase their first multifamily, what type of numbers or analysis do you recommend that they look at before they try to reach out to a commercial lender and say, hey, can you finance this deal, right? That we have cap rate, cash on cash return. What other things should a newbie investor that's wanting to purchase their first apartment complex look at when analyzing the deal, so that we don't waste your time as a lender?
Mm-hmm. Yeah, that's a great question. So ultimately, it depends on the deal. So if you're looking at stabilized transactions, the first thing that deal needs to hit is a DSCR, debt service coverage ratio of 1.25 or better.
Yeah.
That's the first thing. Now, if you're looking at a value add deal, that can be 1% or better. Your DSCR can be 1% or better. Sometimes it doesn't require a DSCR because it's a value add. You need a short-term bridge loan to get it done. So that's the first thing. If you're looking at stabilized deals, 1.25 debt service coverage.
Yeah, and debt service coverage, just for some of the listeners that might not know, is, correct me if I'm wrong, but it's basically for every dollar coming in, if 1.25 ratio, for every dollar coming in, you're making a 25% profit. Is
Correct.
that correct? Yeah.
Yeah.
Okay, cool.
Yep. And then from there, you need to look at net worth and liquidity. And what that means is you have to have a net worth that's equal to or greater than the loan amount. So if you're coming in and you're requesting a loan for $10 million, then you have to have a net worth that's equal to $10 million or more. And so most people think it's just them, like you have to have it, but it's a group. As a lender, we look at the group.
Yeah.
So if you don't have it and you know somebody who do have it, or 4 or 5 people who have a net worth of 2 million, then 5 of y'all can come together and your net worth is equal to 10 million.
Yeah.
So that's another thing, net worth and liquidity. So you have to have a DSCR, debt service coverage ratio of 1.25, and you have to have net worth and liquidity equal to the deal. And then the last thing, you have to have experience. And so if you don't have experience, you go out and you find somebody with experience. I know everybody says it, but it's just like, hey, I don't have experience to do this deal. I've underwrote it. It's a good deal. Will you consider partnering with me on this deal? And sometimes the person who lends you their balance sheet to solve the net worth and liquidity, they have the experience as well. So you knock out 2 birds in one stone with that one partner.
Yeah.
Or if a group of y'all have it, then that knocks it out.
Yeah.
But when doing it, you have to look at it as experience doing deals of this size, So if it's a $10 million deal, you have to find somebody who's done deals of this size before.
Mm-hmm.
And that's the top 3 things that we're really looking for.
Yeah, super helpful. What are your costs and fees typically to finance a commercial property?
Yeah, so to finance a commercial property, we're going to charge you 1 point. That's what you'll pay once we close on it. It's 1 point up front, and then after that, the rest is on a per deal basis. Every loan is different. Everything that we underwrite is a different, to a different standard. Costs vary in every single cost. The cost varies in every single deal, but I know for sure that 1 point is what you should be expected to pay. That's standard across the board.
Yeah. Okay. Is there a typical range that that someone would expect to pay, a range in term, that they would pay on a multifamily loan?
Yeah. So when you say range in term,
like 5 to 7%, interest only, 5-year term, 20-year term. I don't know.
Yeah. So normally the terms are 5 years, 7 years, 10 years, and 12 years.
Okay.
The rates for each term is different. It varies, as you know, it varies on what the Fed is doing. It varies on what the 10-year Treasury is doing. So you can have an adjustable rate mortgage, and that's like if you have a short-term deal, you can do a adjustable rate, which is called an ARM, or you can do. But to answer the question, 5, 7, 10, and 12.
Okay.
Amortizing over 30 years.
30 years. Yep. And
then the rate, it just depends. Right now, I'm seeing rates as low as 3.8.
Wow.
And that's crazy.
That's insane. That's almost like free money.
Correct. Wow. And so it's on a deal by deal basis. But right now, I always tell people right now is the time to, if you have a deal, go ahead and refinance out of it. If you're not locked into for prepayment penalties or anything like that. But now it's probably the best time to be refinancing into a lower debt. And yeah.
Right on. For someone who's trying to finance a property, what do you like to see? Do you like to see a complete package, with kind of like their plan for the property, pro forma, a 30, 50 page report? What are the things that you like to see to make the process go smooth, and to ensure that, the person has the best chance of getting their loan approved?
Yeah. So one thing that I don't like to see is you don't have to send me the whole offering memorandum kind of style kind of thing, because that just takes up too much space on my computer. That's cool. It's cool and it looks nice, but we're only really looking for the meat and potatoes of the deal. So the underwriting, as long as you have the underwriting, that's going to answer all the questions. Because as I said before, the 5 things that we're looking for is the current NOI. Current NOI, pro forma NOI, sources, uses, and exit strategy. And the underwriting that you provide will have all of that in there. So, once you underwrite it, you're going to know what the current NOI is.
Mm-hmm.
And then in your underwriting, you need to have a detailed plan on the sources and uses. What you plan on doing with the money once it comes in. How much is that money? How much of that money is going to be debt? So is it going to be 75% debt, 25% equity? And then from there, out of that capital that you have, what do you plan on doing with it? How much is going to go to fixing the units? And when you go into fixing the units, how much is going to go to the cabinets, the washer, the dryer, the whole rundown? How much is going to go to fixing the pavement, the roofs? Everything should be in that sources and uses. So that way we get a great scope of what you're trying to do. The more detailed it is, the more time we see that you put thought into doing this. And it's not just some fly by night thing. You actually did your homework on this particular opportunity and you're serious about doing it.
Yeah, analyzing and taking the time to run the numbers. You mentioned underwriting. As a newbie, what do you mean by that? Do you mean like, we put together like an Excel spreadsheet with some of the numbers, cap rate, and kind of the basic commercial, financial ratios that we should be looking at? Or are you looking for like a huge PowerPoint presentation? Can you elaborate a little bit more about that underwriting thing that you mentioned?
Yeah, so the underwriting is basically the Excel spreadsheet that goes over what the deal is. The PowerPoint, that's like what you'll do for, when you're pitching somebody.
Yeah.
But for the bank, for lenders, we really like to see the underwriting and we really like to see that Excel spreadsheet. That's the biggest thing. Even if you take a screenshot of it, not a screenshot, but save it as a PDF file, send it over, that's good. But that Excel spreadsheet is what allows us to really get into the deal. And every Excel spreadsheet, you should have your rent roll on there. And that's going to say how many units is what. So how many 1-bedrooms you have, how many 2-bedrooms, how many 3-bedrooms. It should go like that if you're looking at multifamily. If you're looking at office space, you should have your unit mix, what kind of offices you have, and just across every spectrum that you're investing in. And then from there, you go into the T12, how much is coming in, how much is going out, and break it down like that. And then from there, that should generate the metrics that you need to generate as far as what we need to see in underwriting.
Yeah, that's awesome. Cool. And do you want to see some stress tests come from us? Like, some analysis like, hey, what happens if our rents drop by, $50, $100? What does that do to our numbers? What happens if, we lose 15% of our vacancy drops by 15%? What ifs? Do you guys like to see that, or do you guys perform that on your end when analyzing the deal?
Yeah, we normally perform that on our end when analyzing the deal because, of course, you may have one way, but we're going to be a lot more critical about every single thing that we look at because we're investing a large sum of money into this deal. We're putting 75% up, 75% of the capital up. And most people don't think about lenders like that. They just think of it as I got to get a loan and do everything. But the lender is your number one investor because we're putting up 75% of the money.
Yeah.
And so when looking at lenders in that light, then it's like, okay, we're putting up 75% of the capital. So we got to make sure that this is going to pencil out the way it's supposed to pencil out. And if it doesn't happen, then what do we do? And that's kind of the process that we go through.
Yeah. Are there any other stress test examples that you guys go through when looking at a deal?
The main thing is normally what happens if it doesn't go as it's planned to go. What happens if they have to decrease rents? What happens if occupancy drops? What happens if occupancy drop, decrease rents? And it's a lot of things that go into it, but the occupancy and the decrease in rents are the two biggest things that we look at here.
Yeah.
And so, because that's the first thing that happens. If anything happens and it's a panic, people are going to move out. And if they move out, how long does it take before we can't get paid? And then if you want to keep those people in, how much do you have to give them a discount on their rent before you break even or before you're not making any money? Those two things are the biggest things that we look at to say, okay, if this happens, then this will happen. If that happens, then this will happen. And
Is there a range that you guys typically look for when looking at the drop in rents or the drop in occupancy? Like, this deal has to make sense at a 80 or 70% occupancy in order for us to even want to finance it?
Yeah, I think that is on a deal by deal basis
Yeah.
because it ultimately depends on what kind of deal you're looking at, where's the deal located, which one of the food groups it's in. So all that it depends on a deal by deal basis.
Yeah. Okay. Cool. And what's the process like? From start to finish. An investor brings you a deal that they need funding on. From start to finish, what's the timeline look like? And is there anything that the investor can do to help speed that process up?
Yes, our timeline is normally 45 to 90 days. The start of it is the preliminary information that we require, such as the 5 data points that we need: current NOI, pro forma NOI, sources, uses, exit strategy. And then from there, if it checks out, if it seems like it's a great opportunity, then we'll go ahead and send you an application. Once you fill out that application, you're going to attach the net worth and your track record to that application, and that's how we qualify you as a sponsor. And then from there, we're going to go into sending you a term sheet. Once we send you a term sheet, from there, we're going to do our due diligence. Once we do our due diligence, we're going to go ahead and lock in the rate, get everything going. And then from there, you should be off to the races as far as closing.
Yeah. Awesome. Wow. You make it seem so smooth and easy, man.
I mean, yeah, the overall gist of it is very smooth and easy, but it's just like every single step of that process has a lot of different steps involved in it. And, that's why I said 45 to 90 days, but we pretty much got it mapped out where it's like, okay, if you do this, and guide the process along, we'll be all right, But every step, every deal has its own quirks in it.
Yeah. Yeah, that's good to hear. You definitely make me at least feel confident that, working with you, we can get the deal done as long as we follow those steps. I think one thing that, a lot of investors or newbie investors fear is, can I get financing for the deal? How do I get financing for the deal? If I bring this deal to a commercial lender, are they going to back out at, the last minute? What am I going to do now? But you've definitely laid out some framework and, some steps and, things that you guys look for. Can you hear me okay? Hello?
Yeah, you were going out. I stopped that if you're going to a commercial investor.
Yeah, so let me just step back and repeat a little bit.
Okay.
I'm sorry about that. Yeah, so, I think you've laid out a nice framework on, steps that you should follow as a newbie investor to, increase the chances of getting your deal financed. It definitely, makes me feel confident that, if I come to you, and I followed all your steps, depending, each deal is different, but I really feel confident that, working with someone like you who's going to lay out the steps that I need to follow to get my deal financed, is really a good feeling. I hear a lot of stories of people who have tried to get financing on their properties and the lenders have backed out at the last minute. But I think, with you sharing a nice framework and, sharing a little bit more about your process, I think that should ease up some of the tensions that some newbie investors might be facing or worried about.
Yeah. And to add to that, one thing, the lenders backing out at the last minute, that does happen.
Yeah.
But it goes into the beginning of the deal. So going back to the beginning of the deal, it's just how the deal is laid out, So if it's like when people come to me for financing, if it's like last minute and it's rushing to try to get something done, I tell people up front, we can do this, but I'm not 100% certain that you're going to get financed for this deal. I'm not 100% certain that we're going to be able to pull it off in the time that you need pulled off. And most of the time when that happens, they're like, okay, well, let's just try anyway. And then if it falls through, it's like I told you in the beginning that, this timeline is the timeline. We can try to do it if you want to try to do it. But I think in order, to put your best interest first, we shouldn't do it this way, And so, yes, I want to fund the deal, but I also want to make sure that you're making a good decision, Because I think most people think it's one-sided, if I fund it, I make money. If I don't fund it, I don't make money. But if I fund a bad deal, I'll make money right now. But at the end of the day, I got to deal with the other problem on the other end. of taking the deal back.
Yeah, right.
So I would prefer to make sure I fund a good deal to make sure that we don't have to do that, because that's a long process. You got to get attorneys involved. You got to pay
Yep.
fees. Nobody wants to do that, and you can avoid that just by doing it up front.
Yeah.
And sometimes when you tell investors, that's old investors or new investors, that this opportunity may not be the best opportunity. A lot of people have most emotions, and that's what goes into it. And it's just like, feel like you're not believing in the deal or their dream, but it's just like, I'm looking at it black and white here, and I'm telling you the facts straight up. This is what it is,
Yeah.
And I don't know.
It's
Just
always
make
good
sure
to be
you have enough time.
transparent, right up front. So, there's no wrong expectations, and 45, 90 days down the line, they hear that they can't get their deal funded.
Correct. I give you a quick no or a quick yes. And if it's a yes, we can roll. If it's a no and it's a quick no, I can tell you why it's a no.
Yeah. Yeah, that's super valuable. Awesome. Well, hey, as we close out here, just a few more questions. You've provided a lot of value. I've learned a lot from you, and I know our listeners will, gain a lot of information from you. But as we close out, just some quick, easy questions here. What's your favorite book other than, The Rich Dad, Poor Dad? Real estate or non-real estate related?
The Go-Giver.
Never heard of that. What's
By
that about?
Bob Berg. It's about giving. So just giving everything away.
Yeah.
And when you're giving everything away, you're opening yourself up to receiving.
Yeah, that's definitely true. And, I haven't really realized that until recently, starting this meetup, starting this podcast. I've been able to network with a lot of individuals, that are doing some huge, amazing things. And just being around them, is so powerful. You I hear that you become the 3 people that you surround yourself with. And, it's just a good feeling, being able to network with these people, learn what they're doing, and hopefully replicate, their model. But yeah, that's definitely true. If users or if listeners want to get in contact with you, what's the best way for them to get in contact with you?
Okay. Yeah. So if you want to get your deals funded, you can get in contact with me at Roddrick@apartycapitalmarkets.com. And then if you want to partner on multifamily real estate deals, you can get in contact with me at Roddrick@rjonescapital.com.
Okay, great. Awesome. And I'll put all those in the show notes. But yeah, once again, Roddrick, I want to thank you so much for being a guest on the podcast. I've learned so much, like I said, and I think our listeners will definitely feel more confident when, evaluating a deal and looking for financing on the property. So yeah, thank you again for being a guest on the show.
Thank you for listening to the Become a Billionaire with Me podcast. If you liked what you heard, please help by giving us a 5-star review on iTunes. If you have any suggestions, please feel free to make a comment in the comment section. Let's become billionaires together.